Welcome to Kaplan Professional Education's 5 Minutes with the Industry. I'm Victoria Papandrea, and today I'm speaking to Louis Christopher from SQM Research about the current and future outlook of the Australian real estate investment trust sector. Louis, thanks for joining me today.
No problem, Victoria.
Louis, since the emergence of the first AREITs in the early 1970s, how have they performed over the last 40 years?
Over the long term, the performance of AREITs has certainly varied. There's been periods of significant outperformance, and then there's been periods of significant underperformance. Through the period of the 1990s and the early 2000s, we saw a period of fairly strong outperformance, and it was actually gathering quite a lot of steam right up until 2007, where clearly the AREITs were significantly outperforming general equities. But when 2008 came, because of the high level of gearing in the sector, there was a massive crash in the AREIT market. From peak to trough in 2008, AREITs corrected by 75%. Quite a crash when you consider what happened in 1987 with general equities in this country, where we had the one-day decline of 25%. Since 2008, we've actually seen massive outperformance of the local AREIT sector. Still, we've had some volatility. So, for example, in 2011, there was another correction of a lesser magnitude. We're talking about a correction of running just under 20%. And so far in 2012, we've actually seen a bit of outperformance once again.
What are some of the benefits AREITs can offer investors?
AREITs generally can offer investors a higher yield. So for many AREITs, you can actually buy into these REITs with a 7, 8, 9 and perhaps even a 10% distribution yield. The other key benefit, of course, is the exposure to the underlying real estate, and at times the ability to actually buy into these AREITs when the prices are trading below their net tangible asset backing. For the record, most AREITs in Australia have been trading at a discount to their net tangible asset backing since 2008, and when we exclude the likes of, say, Westfield, that discount has been ranging at around 20%.
Louis, what are some of the risks associated with AREITs?
Besides the level of gearing, the general volatility that comes with that level of gearing, of course you're taking general property risk. There is a risk in this country that property values may go down. There is a risk that rents may not go anywhere or also may fall. It's important to note, though, you're also taking management risk. So how are those properties being managed? When you're buying into an AREIT, you're buying not just the property, but you're buying into the management that looks after those properties. And the reality is out there is that management across Australian real estate investment trusts is varied. You have some very good operators out there doing a great job in adding fantastic value for investors. And then you have some not so good operators out there who have literally subtracted value away from investors.
Of the risks that you've mentioned, is it possible to mitigate some of those?
It is possible to mitigate some of the risks. For example, by studying the balance sheets of many of these AREITs, you'll be able to get a good idea in terms of which ones are highly geared and which ones are less geared. It's also dependent on what type of risk you are willing to take. Naturally, the highly geared REITs, there's potential for significant upside. Volatility itself is based on gearing, so the lower geared ones, you'll be able to reduce volatility there. But it's also about studying each of the REITs there. So I would strongly recommend looking at the track record of management. Have they got it right in terms of making the correct calls on acquisitions and disposals in the past? And has that translated into outperformance or underperformance?
Louis, do you think AREITs have a role in a contemporary investment portfolio?
I strongly believe REITs and indeed unlisted property trusts have a significant role in a balanced portfolio. They can bring fairly high distribution yields and, if researched well, lower volatility than your general other underlying asset classes. That's quite possible. So yes, it's worthwhile having an exposure. The question is, how much of an exposure shall you have?
Just finally, Louis, what are the possible future trends that may affect AREITs?
I believe that we're going to see continued rise in payout ratios back to about, say, 95%, and then some will even return back to 100%. I think beyond 100% though, it's unhealthy for the sector long term. We're not seeing many AREIT managers trying to raise capital to actually pay down debt. What we're seeing now though is basically rights issues and placements being made to actually go and buy real estate. So that's starting to actually occur. So I believe that we will see balance sheets actually start to expand again going forward from this point. This, of course, though, assumes that we have some type of normalcy with the global economy.
Louis, thanks for your time today.
No problem.